Most traders think they need more indicators, more data, more screen time. They believe the profitable 5% have access to better tools, secret strategies, or insider knowledge. That's the comfortable lie. Here's what nobody wants to hear. The top 5% aren't doing more, they're doing radically less. While you're drowning in 47 indicators like David, the software engineer who burned through $65,000 in 18 months, Sarah, a former casino dealer with 3 simple rules, grew her account 42% in the same period. Same markets, same opportunities, opposite results. The difference isn't intelligence or capital. It's that the 95% are fighting a war they've already lost by making trading impossibly complex, while the 5% are playing a game they've designed to be boring, systematic, and obvious. In the next few minutes, I'm going to show you the 5 specific reasons trading feels impossible right now, why your instincts are actively sabotaging you, and the exact mental shifts that transform this from a chaotic battle into a predictable routine. By the end, you'll understand why you've been struggling, and more importantly, what to stop doing immediately. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let's start with the first trap that's probably destroying your account right now, and you don't even realize it. Every profession you've ever worked teaches you the same lesson. Certainty comes from preparation. Study harder, get better grades, work more hours, earn more money, analyze deeper, make better decisions. This formula works everywhere except trading. And that's exactly why it's killing you. Your brain is wired to crave certainty like it craves oxygen. It's a survival mechanism. Our ancestors needed to predict where the predator would attack, where food would appear, when danger was coming. Uncertainty meant death. So your brain does everything possible to eliminate it, and in trading, this instinct becomes your enemy. Here's what happens. You open your charts and you see price moving. Your brain immediately asks, what's going to happen next? This question feels natural, even necessary. So you add a moving average to help predict direction. Then RSI to confirm momentum, then MACD for convergence signals, then Fibonacci levels for support areas, then volume profiles for institutional activity. Before you know it, you're David. 47 indicators, 3 hours of morning analysis, and a screen that looks like a Las Vegas casino having an identity crisis. But here's the brutal truth. You're not adding indicators to improve your trading. You're adding them to feel safe. Each new indicator is a psychological security blanket. It whispers, now you know what's coming, now you're prepared, now you can predict. Except you can't, and you never will. The market doesn't care about your moving averages. It doesn't respect your Fibonacci levels. It will do whatever thousands of participants collectively decide in real time, and that's fundamentally unpredictable on any single trade. David spent 18 months trying to build a crystal ball out of technical indicators. He burned $65,000 learning what Sarah already knew from watching gamblers for a decade. You don't need to predict the next card to have an edge. You just need favorable odds and the discipline to play them consistently. This is the uncertainty paradox. The harder you try to eliminate uncertainty, the worse your trading becomes. You're solving the wrong problem. The question isn't, what will happen next? The real question is, what do I do when my setup appears? See the difference? One requires prediction, which is impossible. The other requires recognition and execution, which is completely controllable. The professionals don't say this will go up. They say this setup has worked 63% of the time over 200 trades, with a 1.8 risk-reward ratio. I'll take the bet knowing this specific trade might lose, but my edge plays out over volume. That's not prediction. That's probability management. And the moment you make that mental shift, from trying to know to being willing to not know, trading gets exponentially easier because you stop wasting mental energy on the impossible. Now you might be thinking, oh, but wait, if I can't predict, how do I know when to enter? And that's where most traders fall into the second trap, the one that makes them feel productive while actually making them worse. Your brain has a quirk. It confuses activity with progress. Learning a new indicator feels like you're improving. Reading another trading book feels like you're getting closer to success. Watching 3 hours of market analysis feels like preparation. But none of that is trading. That's just consumption wearing a productivity mask. This is complexity addiction, and it's insidious because it feels so right. Every time you lose a trade, your brain offers a seductive solution. You need more information. Add another layer of analysis. Study another strategy. So you do. You subscribe to another newsletter. You follow another guru. You add another oscillator. Your trading system grows like a tumor, not because it's making you more profitable, but because complexity satisfies your brain's desperate need to feel like you're doing something. I see this constantly. Traders with 6 monitors, 18 indicators per chart, 3 different trading rooms open simultaneously, economic calendar on one screen, Twitter feed on another, order flow software, market depth analysis, correlation matrices. They look like NASA mission control. They feel like professionals. They trade like amateurs. Because here's what actually happens in the moment of decision. All that information creates paralysis. One indicator says buy, another says wait. The economic data is mixed. The guru on Twitter just posted a bearish thread. The order flow shows institutional selling, but your moving average is bullish. Your brain tries to synthesize 15 conflicting inputs and just freezes. You either miss the trade entirely or take it with zero conviction, exiting at the first sign of trouble. Compare this to Sarah. 3 rules. That's it. Rule 1. Only trade during the first 2 hours after market open when volatility creates her specific setup. Rule 2. Risk exactly 1% of her account, calculated before she enters. No exceptions, no adjustments. Rule 3. Exit at her predetermined level, whether it's a win or loss. No hoping, no second guessing. When her setup appears, she doesn't think, she doesn't analyze. She doesn't check what 14 other indicators are saying. She executes. Click. Done. Then she waits for the next setup. Someday she takes 0 trades because her setup doesn't appear. That's fine. She's not trying to force the market into giving her opportunities. She's waiting for the market to give her the one opportunity she's designed to capture. This is sophistication through simplicity. The amateur thinks more tools equal better trading. The professional knows that more tools equal more confusion under pressure. Because when you're in a trade, and it's moving against you, and your heart is pounding and your palms are sweating, you don't want complexity. You want clarity. You want a simple rule that tells you exactly what to do. If you're finding value in this breakdown of why your trading instincts are sabotaging you, do me a favor and hit subscribe. This channel exists to cut through the noise and show you what actually works, not what sells courses. Turn on notifications because the next video is going to reveal the specific mental trap that makes traders abandon winning systems right before they work. Now, here's where this gets really dangerous. Even if you simplify your system, even if you accept uncertainty, there's a third trap that destroys most traders. And it's the hardest one to see because it feels like you're measuring success correctly. You wake up, check your account balance, down $300 from yesterday. Your stomach tightens, you feel slightly anxious, maybe a bit depressed. The next day, you're up $500. You feel great, confident, maybe even a bit invincible. Your emotional state is entirely dependent on your account balance, and this is slowly destroying your trading psychology. This is outcome obsession, and it's particularly insidious because measuring results feels logical. Isn't the point of trading to make money? Yes, but here's the problem. You control nothing about outcomes. Nothing. You don't control whether the market moves up or down. You don't control whether your valid setup works this time or fails. You don't control whether this week is profitable or not. Those are all determined by market behavior that you cannot influence. You control exactly one thing: whether you followed your rules. That's it. Did you wait for your setup? Did you size your position correctly? Did you manage risk according to your plan? Did you exit where you predetermined? Everything else is noise. Most traders measure success by dollars made today. This creates an emotional roller coaster. 3 winning trades and you feel like a genius. 2 losing trades and you question everything. Your confidence swings wildly based on random short-term variance. You're measuring yourself by a variable you don't control, which means you're building your psychology on quicksand. The 5% measure success differently. They have a checklist. Not, did I make money, but did I execute my process? If they can answer yes, if they saw their setup, entered with proper size, managed the trade according to plan, and exited at their predetermined level, they mark the day as successful, regardless of the monetary outcome, because they controlled what was controllable. Think about how this changes the psychology. 2 traders take the same trade, both get stopped out for a loss. Trader 1, measuring by outcomes, feels terrible. Another loss. Another day of being wrong. His confidence takes a hit. He starts questioning his system. Maybe he needs to change something, add an indicator, adjust his rules. He's in emotional chaos. Trader 2, measuring by process, feels fine. Maybe even satisfied. He saw his setup, executed his plan exactly as designed, managed risk properly, and accepted the result. The market just didn't cooperate this time. That's expected. His edge plays out over volume, not on any single trade. He's in emotional stability. Same trade, same loss, completely different psychological impact. One trader is being destroyed by outcome obsession. The other is being strengthened by process focus. And over time, this difference compounds. The outcome-focused trader makes increasingly emotional decisions. The process-focused trader makes consistently mechanical decisions. Guess which one is still trading a year later? David checked his account balance 14 times a day. Every red tick felt personal. Every green day inflated his ego, making him overtrade the next day. His emotional state was a puppet on strings controlled by random market movement. Sarah barely looked at her P&L during trading hours. She had her checklist. At the end of the week, she'd review her statistics: win rate, average winner, average loser, adherence to rules. If her process was solid, she knew the profits would follow. And they did. 42% account growth in 18 months while David was blowing his fourth account. But even if you master process focus, there's a fourth trap waiting. And this one is particularly dangerous in the modern age because it disguises itself as being informed. You wake up and immediately check your phone. 3 trading newsletters in your inbox. You read them while having coffee. Then you open Twitter, 20 trading accounts you follow, all posting their analysis. You watch 2 YouTube videos breaking down overnight market action. You check Bloomberg for economic headlines. You scan Reddit for sentiment. By the time the market opens, you've consumed 17 different opinions about what's going to happen today. You feel informed. You feel prepared. You're actually paralyzed. This is information overload, and it's the silent killer of conviction. Because here's what nobody tells you. Every piece of information is just someone's opinion. Every analysis is one interpretation. Every headline is one angle. When you consume all of it, you're not getting clarity. You're getting noise disguised as knowledge. Your brain tries to synthesize all these conflicting inputs. One analyst says the market's breaking out. Another says it's a bull trap. The economic data shows strength, but the technicals look weak. Sentiment is bullish, but positioning is crowded. You're trying to reconcile 15 different perspectives, and it's impossible. So you freeze. Analysis paralysis sets in. You miss your setup entirely because you're too busy wondering if you're seeing what everyone else is seeing. Or worse, you take the trade with no conviction. The moment it moves against you, doubt floods in. Maybe that analyst was right about the bull trap. Maybe I should have waited for confirmation like that Twitter account suggested. You exit early, taking a small loss on what would have been a winner if you just stuck to your plan. The information didn't help you. It contaminated your execution. Sarah practiced what I call strategic ignorance. She deliberately limited information intake. She didn't watch financial news. She didn't read analyst reports. She didn't check social media during trading hours. She had her 3 rules and her specific setup. When it appeared, she executed. When it didn't, she waited. External information couldn't confuse her because she didn't consume it. Her edge existed in a closed system, her rules, and her execution. Nothing else mattered. David did the opposite. Every morning, 3 hours of consumption, reading, watching, analyzing. By market open, his head was full of conflicting information. He'd see his setup, but then remember some analyst's warning about the current market structure. He'd second guess. He'd hesitate. He'd either miss the trade or take it without conviction. The information he thought was helping him was actually his biggest obstacle. The professionals understand something crucial. Past a certain point, more information doesn't improve decisions. It degrades them. There's a threshold, probably much lower than you think, where additional information stops being signal and becomes pure noise. And most traders crossed that threshold years ago without realizing it. Think about it this way. If you have a system that works, a setup that has proven edge over hundreds of trades, what can today's economic headline possibly tell you that changes that edge? Nothing. Your edge exists independent of the news cycle. Your setup either appears or it doesn't. The execution is either correct or it isn't. The financial media's narrative about why the market moved has zero impact on whether you followed your rules. But your brain doesn't want to accept this because limiting information feels like willful ignorance. It feels irresponsible, like you're trading blind. This is the trap. You're not trading blind when you ignore noise. You're trading with clarity. You're protecting your conviction from contamination. You're ensuring that when your moment comes, you can execute without 17 voices in your head creating doubt. This brings us to the fifth trap, and this one might be the hardest to overcome because it requires you to do something that feels completely wrong. Nothing. You're sitting at your desk. Markets are open, charts are moving, prices are fluctuating, opportunities everywhere, or so it seems. You feel this pressure building. You should be doing something. You should be trading. That's why you're here, right? To trade, so you scan for setups. You force patterns that aren't quite there. You lower your standards just slightly, because sitting still feels like you're wasting time. You take a marginal trade because at least you're doing something. This is the activity trap, and it's rooted in a fundamental misunderstanding of what trading actually is. You think trading is about working, about putting in hours, about being busy. It's not. Trading is about hunting. And hunters spend most of their time doing absolutely nothing. Watching, waiting, conserving energy for the moment that matters. Michael was a day trader who used to take 20 to 30 trades per day. Constant action, constant stress. He felt productive. He felt like a professional. His monthly results? Slightly negative to barely break even. He was working hard and going nowhere because he was confusing activity with progress. Then he made a radical change that his brain absolutely hated. He limited himself to 3 trades per day maximum. Not 3 setups that he might take, 3 actual trades. If his A+ setup didn't appear, he took 0 trades. Some days he'd sit for 8 hours and do nothing. Just watching, waiting, managing existing positions from previous days, but not entering anything new. His brain screamed at him. This is a waste of time. You're just sitting here. You're not working. You're missing opportunities. But he stuck with it because he understood something the 95% never learn. In trading, doing nothing is often the most profitable action you can take. It's not passive. It's active discipline. It's the willingness to wait for your edge instead of manufacturing trades to feel productive. The results were immediate and dramatic. His win rate jumped from 42% to 61%. His average winner got bigger because he was only taking the absolute best setups with the most room to run. His mental clarity improved because he wasn't emotionally exhausted from managing 15 simultaneous positions. His monthly results went from break-even to consistently positive. Same markets. Same strategy. The only difference was selectivity. He stopped forcing trades and started waiting for obvious opportunities. This is what patience as a strategy actually means. It's not about being lazy or passive. It's about understanding that the market will always offer another opportunity. Always. Tomorrow, next week, next month. But your capital? That's finite. Your mental energy? That's finite. Your emotional resilience? That's finite. Every marginal trade you force depletes these limited resources without giving you your edge. The 95% feel they must trade to work. They see themselves as active participants who need to be constantly engaged. The 5% see themselves as selective predators who preserve their resources for the moments that actually matter. They're not trying to catch every move. They're trying to catch their move, the specific setup they've designed their system around. And here's the critical insight. When you stop overtrading, when you limit your exposure to only your highest conviction setups, something magical happens. Your execution improves dramatically because you're not burned out. Your conviction strengthens because you're only taking trades you genuinely believe in. Your results improve because edge compounds when you apply it selectively, not dilute it across 100 mediocre opportunities. But there's one more shift that ties all of this together, and it's the deepest level of transformation. It's not about what you do, it's about who you are. Right now, your identity is probably tied to your results. When you have a winning day, you feel like a successful trader. When you have a losing day, you feel like a failure. Your self-worth is on a roller coaster, controlled by random market fluctuations. This makes you psychologically fragile because your ego is invested in outcomes you cannot control. The 5% have made a fundamental identity shift. They don't see themselves as profit chasers. They see themselves as rule executors. Their identity isn't "I'm a trader who makes money." It's "I'm a trader who follows my process with unwavering discipline." This subtle language shift reveals a massive psychological transformation. When your identity is rule executor, a losing trade doesn't threaten who you are. You didn't fail at being a rule executor. You executed perfectly. The market just didn't cooperate this time, and that's completely expected because your edge is probabilistic, not deterministic. Your self-worth remains stable because you succeeded at the only thing you can control, following your rules. Conversely, when you have a winning trade, you don't get inflated with ego because you know it's not genius. It's the natural result of executing your edge. Tomorrow you'll do the same thing regardless of today's outcome because your identity isn't tied to the random fluctuations. It's tied to the process. This makes you psychologically bulletproof. David's ego was completely dependent on his daily P&L. Red days crushed him. Green days made him overconfident. He was on an emotional roller coaster that eventually threw him off completely. Sarah's ego was tied to one question. Did I follow my rules today? If yes, she was successful regardless of the monetary outcome. This created psychological stability that compounded into consistent profitability. Think about how different these two mindsets approach the same situation. Both traders have a week where they follow their rules perfectly, but the market doesn't cooperate. 5 losing trades in a row, all proper setups, all managed correctly, just bad luck with short-term variance. The profit chaser looks at his account balance and feels like a failure. I'm down money. I'm losing. Something's wrong. Maybe I need to change my system, adjust my rules, try something different. His identity as a successful trader is threatened, so he makes emotional changes that often destroy what was actually working. The rule executor looks at the same week and feels satisfied. I executed my process perfectly. 5 setups appeared 5 times I followed my rules exactly. My system has a 60% win rate over volume, so a 0% win rate over 5 trades is well within statistical variance. I'll keep executing. The probabilities will play out. His identity as a disciplined trader is reinforced, so he stays consistent through the variance. 6 months later, the profit chaser has changed his system 3 times, blown another account, and is wondering if trading is even possible. The rule executor is still executing the same system, has weathered multiple losing streaks without flinching, and his account is steadily growing because consistency always wins over time. This is the final and deepest shift. When you stop being a trader who chases money and become a trader who executes rules, the money follows naturally because you're no longer operating from desperation or greed. You're operating from discipline and patience, and those are the only two qualities that actually generate long-term profits. Now here's what nobody wants to tell you, because it doesn't sell courses or generate exciting YouTube content. Once you make all these shifts, trading becomes boring. Really, really boring. You wait. You watch. You execute when your setup appears. You manage the trade. You exit. You wait again. Hours of nothing interrupted by moments of focused execution. The 95% can't handle this. They need excitement. They need action. They need the dopamine hit of constant trading. They need to feel like they're doing something important. Boredom feels like failure to them. So they overtrade just to feel productive. This destroys them. The 5% have made peace with boredom. They understand that boredom is the price of consistency, and consistency is the price of wealth. They're not looking for excitement. They're looking for repetition. They want to do the same boring thing over and over because that's how edge compounds into serious money. If you're finding trading exciting, you're probably overtrading. If it feels like a roller coaster, you're probably trading emotionally. If every day is dramatic, you're probably not following a system. The path to making trading obvious is making it boring. Systematic, repeatable, predictable in execution even when outcomes vary. Sarah doesn't talk about trading much anymore. It's just part of her routine, like brushing her teeth. She executes her 3 rules, manages her positions, and goes about her day. That's the sign you've made it. When trading stops being a dramatic battle and becomes a boring routine. When you stop asking, "How do I predict the market?" and start asking, "Did I follow my rules today?" David never made this shift. Last anyone heard, he gave up trading entirely. Went back to software engineering, blamed the algorithms, the manipulation, the unfair advantages of institutional traders. Never once looked at the real problem. He was fighting the wrong war. He was trying to beat the market instead of simply executing his edge. The market doesn't care which path you choose. It will keep offering opportunities regardless. The question is, will you still be in the game when those opportunities appear? Or will you be another statistic in the 95% who found it impossible because they refused to stop fighting and start flowing? The difference between impossible and obvious isn't talent. It's not luck. It's not capital. It's simply whether you're willing to kill the complexity, kill the need for certainty, kill the outcome obsession, and embrace the boring simplicity of systematic execution. That's it. That's the entire game. Everything else is just noise designed to make you feel like there's more to learn when really there's just more to unlearn. You probably came into this video expecting to learn about some sophisticated technique the top 5% are using. Maybe a specific indicator combination, a market structure secret, or some algorithmic approach you hadn't considered. The assumption was that profitable traders have access to something you don't. But now you understand the truth. The 5% aren't doing more, they're doing radically less. They've stopped fighting 5 battles that can't be won. Trying to predict the unpredictable, adding complexity to feel productive, measuring success by outcomes they can't control, consuming information that paralyzes decisions, and forcing trades to feel like they're working. The shift from impossible to obvious isn't about learning a new strategy. It's about unlearning everything that makes trading harder than it needs to be. It's accepting uncertainty instead of fighting it. It's simplifying ruthlessly instead of adding layers. It's measuring yourself by process, not profit. It's treating less information as an advantage, not a weakness. It's understanding that patience isn't passive. It's the most active strategy you have. And maybe most importantly, it's recognizing that when trading becomes boring, systematic, and routine, that's not a sign you're doing it wrong. That's the only sign you're doing it right. David fought the market for 18 months and lost everything. Sarah executed 3 simple rules for 18 months and grew consistently. Same markets, same opportunities. The only difference was David kept trying to make trading into something it isn't, while Sarah accepted it for exactly what it is. A probability-based game where discipline beats intelligence every single time. You now have a choice. Keep searching for the next indicator, the next strategy, the next piece of information that will finally make it all click. Or strip everything back, build your edge around simplicity, and execute it with the discipline of a machine. The market will be here tomorrow. The question is whether you'll still be in the game, or whether you'll be another trader who found it impossible because you refused to make it obvious.